Good morning, everybody. It's Dan Kautz.
Morning, Jeff Buckley.
And here we are for July already. I mean, I said that last month when we were at June. We're halfway through the year, and boy, time flies. And it's so tough to get everything you need to get done in the summer, get done.
Yes.
I mean, how many times are we fighting over graduations and weddings and this party there and that party there? But thankfully, the weather's been in our favor up here in the Northeast.
Yes, very, very nice summer so far. Yeah.
So let's get to it and take a look and see how we look for the markets. But I always forget this slide. I got to do my little compliance dance here. I want to say this is a quick check-in. Remember, we cannot take any texts or live phone calls or live texts during the recording of this. And our contact information here is dkautz@kautzbuckley.com, jbuckley@kautzbuckley.com. Our phone number is 716-276-8480, and the ever-popular text number. And remember, when you do text that, it goes to everybody.
Yes.
So that goes out to some of my friends that are out there thinking it's a private text line. So listen, let's get into the numbers. Jeff, you always take a lot of time to put this together. You got it really down to a nice science where you always say, let's take a look at in the rearview mirror and then let's look forward, right?
Yes, that's right. Yeah, I like to start with the look in the rearview mirror to give us an idea of where we've come so far. And because it is July now, we've got a half a year to look back over. So it's always a good time to kind of stop and see how we've done so far. Start, headlines right out of the gate here. The S&P 500 and the NASDAQ 100 ended the second quarter of the year, that was through the June 30th, at new all-time highs, or very close. If you can see over the last column over here closest to me, we were just a touch below for the 52-week highs, but those were the all-time highs that we had set. So it really was a and we've talked about this before, very interesting first quarter, second quarter, where the wheels kind of fell off there with the announcement of the tariffs, but then we recovered in a very strong way,
Yep.
really. And so, we've been able to kind of finish the first half really in just about everything in positive territory. Now, this is a little bit of a different chart than we've used before. It's referring to U.S. benchmarks. But these are some different benchmarks that I think give us even a greater kind of in-depth perspective here. I'll start at the bottom because the Russell 2000, this is important because this is the 2,000 really small companies in our economy. This isn't your Nvidias or your Apples or anything. These are the small companies.
One location.
Yeah.
Maybe 100 or 50 employees, somewhere in there.
Regional, but they are publicly traded.
Right.
I mean, they are still publicly traded companies, so they're significant, but we're still struggling a little in this area. This has been down, it's down 11.8% from its high over the last year, which would have been really probably it would have been its all-time high. But we're also down in the first half still, and that's still a sign that the overall economy, there's still some concern out there, because the concern that affects those companies of that size really are a lot of the tariff uncertainties that are still out there, and trade issues and what it's going to cost those companies to purchase the supplies that they turn around and sell to individual consumers in our economy. So,
and they're very reliant on debt, local debt. In other words, they have to take loans and stuff like that.
Yes, that's
They may
true,
not
too.
have a whole bunch of cash, so not having that little bit of uncertainty means, do we have the money in the bank to get it? Right. So that may be some of the reflection of the negativeness there.
Yeah, and they also it limits the individuals that are running those companies to have the ability to kind of look into the future. However, now we can kind of contrast that with really at the top of the chart here. These are we've talked about the NASDAQ before, which is the National Association of Securities Dealers. This NASDAQ composite here, this is the index that really follows probably the high growth companies mostly, and then also the high tech companies in our economy. And so that's really seen exceptional growth over the last couple of years. That's where a lot of the artificial intelligence stocks are, the chip manufacturers, that kind of thing. But the NASDAQ equal weight and the NASDAQ 100 are two ways to break this index apart and look at just components of it. So the NASDAQ 100 are the 100 best companies, the stock of the 100 best companies that are in as a part of that NASDAQ composite. And then the equal weight is where we take all the companies that are a part of that index, and we give them each an equal weight. So the smallest company in that index is going to be compared equally to Apple, okay, or something like that. So really what this shows is a couple things. And also let me point out one more thing, and then I'll get to my point here. The Magnificent Seven, that's the stocks that some of those are very high-tech oriented companies. Those are usually referred to within the S&P 500, and that's where we've been kind of joking over the last couple of years that we had the Magnificent Seven, and the other 493 companies that made up the S&P 500. So really what Dan and I see when we look at this is Magnificent Seven, one of the worst performers as a group for the first half of this year, but yet the NASDAQ 100 and the equal weight have done very well. S&P 500 has done pretty well. Equal weight also has done really pretty well.
And that's a very positive sign.
Yes. And it's positive because what's that showing everybody is we're getting away from everybody buying their Apple stock and just letting it ride. We're starting to spread out where people are investing. They're seeing value in stocks that make up the other 493 of the S&P 500 or the other companies that make up the NASDAQ Composite Index. So it's showing that we've got breadth out there in the market, and that is a very positive sign. So we've got that 9 of the 11 large cap sectors. So when we break our economy down into companies of different industries, businesses, 9 of 11 of those categories were all doing very well, positive year to date. So
Jeff, great explanation. Thanks, because especially the equal weight, it really shows that what I would refer to as the plain Jane stocks are really, they're carrying the day. You're no longer going after the shiny penny.
Yeah.
And how we would say the market's held up on stilts, but 7 stilts.
Yes.
Now the market's being held up by a good foundation.
Yeah.
And that's the S&P 500 versus the equal weight. So great news and good news.
Yeah. Good news again, and again, anytime we see that breadth, that's very positive. And one highlight, and then we're going to jump to the next slide, industrials and financials at new highs, and that signals economic strength. So you've got one of those sectors I was talking about, that's your industrials. Those are the companies that manufacture things. The Trump administration, they're doing their best to encourage companies to reshore or onshore their manufacturing capabilities. And I don't know if we're actually seeing the results of that yet, but the industrial stocks, the companies that make stuff, are starting to benefit from that kind of that reshoring, I think, efforts a little bit, and financials as well. We're entering a period where the Trump administration has expressed their intentions to deregulate the financial industry. And as I think this is at this point, it's probably still anticipation that those are coming, but I think there's hope for that. At least.
So the reason why I laugh is I don't think we got enough done in 168 days in this guy's presidency. Right? I mean, holy cow, it's been crazy.
Yeah.
And we have to take a lot of this information with today. This is where we are, but this is good news.
It's good news, but that's a very good point, and we're going to see that as we work through these a little bit more. But even jump to the next slide there. And you can see that, 2 of the best performing sectors, really the industrials up there, that's an interesting sign. It's a sign that our overall economy it does seem to be pretty healthy. The financials are right up there too. Even utilities, there's such now a push for, with artificial intelligence that the demand on our power grid is going to be increasing exponentially. So there's a lot of effort to try to bolster that utilities. So you've got your utilities, you've got companies that are regulated that provide us our electric service, and then you also have companies that are private that operate in that utilities sector that sell additional power to the grid and everything. A lot of the growth that we're seeing are some of those private companies, but it's still an expression that there's going to be some infrastructure spending and everything that's really going to bolster, I think, the electric power generation area in this country.
Yep.
So just kind of an interesting quick snap, and again, we're very close to 1 year 52-week highs, but those really are the all-time highs too, and we're really close on just about everything. There's a couple sectors that are still trailing a little bit. Healthcare has been a little bit of a surprise.
Yeah, I would expect that always to be a little bit of a stronger sector.
I think a lot of that has to do with, again, policy. We're not,
Yep.
we really don't have definitive policy yet on Medicare, Medicaid.
That's exactly where I was going
Yeah.
to go with it. I mean, we have a lot of good numbers. We talk about following the signs, going for the higher ground. I feel we've been successful on that, but we got to keep our head up and we got to follow the map.
Right.
This is, healthcare is probably, like you said, due to uncertainty on the Medicare. The other thing that Medicaid, the other thing that recently came up too is the copper tariff. And
Yeah.
that could be materials. Also, that could probably, that may have a little bit on industries. Copper builds economies.
Yes.
You know, that's
we don't-
important. I don't want to be the Danny Downer here.
Well, and we don't want to make sure people, if you
right.
look at your portfolios and you happen to own some stock of Johnson & Johnson or some company, in the healthcare sector.
No reason to be worried.
Right. This is the entire sector. This doesn't necessarily mean that every company in there is suffering. I mean, there's always good companies in every sector out there that's named.
And that is why we use individual stocks.
Yes, and
versus
diversify.
And diversify.
Too, exactly.
So, all right. Moving on to this
Yes.
chart here. Now, before, all those numbers we looked at before were equities. They were the equity side. Those are the stocks. Remember, stocks have a lot of, this is the trend of the market. This is how we feel things are going, the forward look. Now with this chart, you bring in fixed income, which would be your bond holdings.
Right.
And remember, bond is the health of the market.
Yeah.
So here at the top, we start with an 80% equity, 20% fixed income. How do we do, Jeff? Walk us through the slide.
Well, yeah, and again, just on your point, before we even get into the numbers, this is very important to Dana and I. This is a little bit of a snapshot where we are like right now. I think I got these numbers as of July 7th. But the point is that this is much more reflective of the portfolios that our clients have.
Reflective, not exact.
Not exact.
I just want to be
definitely.
careful. Right?
But yeah, it really kind of runs the gamut. I mean, more of a 20%
Right.
equities, 80% fixed income is going to be a more conservative investor, whereas someone that's more 80% equities is going to be a more aggressive investor. So you may fit somewhere in there. But the point is, those first couple charts, we like to show those because the stock market is very important, obviously, in that performance.
This is a good forward indicator.
Yes,
Indicator.
But this is that more of a snapshot of how your portfolio
Right.
may actually be performing. And I think what we saw, Dan and I, when we were just taking a look at this, there's not one negative number on
Right.
here.
Yes. Last month we were like, it's getting a little better. Month before it was like, ooh, look at all the negatives.
That's right. And
Look what time does. Look what time does.
Because it's the 3-year, this column refers to the 3-year performance. So now we've kind of dropped off at least part of the year for 2022, which was a very difficult year. So we're starting to now pick up the good performance we've had the last couple of years. And even when you factor in that good performance and include it with the year like 2022 and go back a full 5 years, the performance recently has been good enough that we're still seeing
Takes
no
away the
negatives.
negatives.
Yeah, exactly. But this kind of shows this is a year-to-date performance. So this would be through the first half of 25 and then going back a full year. So starting in July of last year. And both of those, I mean, there's always going to be a little, if you're willing to take a little bit more risk and we have a favorable stock market like we have the last couple years, you're going to see a little bit better performance if you're overweighted to equities. But even people that are even the 50-50, we've gotten a decent rate of return here, yes, over the year to date. And then when you go back a full year, it's been even better. So your portfolios have probably been performing very well. Even with an allocation, a more conservative allocation, we're getting a decent rate of return on your fixed income or your bond holdings. So that's really helping too.
And that gives us certainty. Remember, the bond holdings give us certainty. So, Jeff, this is a great chart to just support your saying that you say all the time. What is it? It's time.
Time in the markets, not timing the markets.
Exactly.
Yes.
And this is exactly what this shows. And people that held on, which all of our clients did through the tough days of April, May, and June, again, following the signals, heading for the higher ground, reward has been had.
Yeah.
Now let's take a look. This is from City National Rockdale, one of the money managers we use. It's the speedometers. We talk about it regularly. And this is a look forward. This is how do we feel things will be going over the next 3, maybe 6 months? The last 3 months, May, June, and July, we've been in neutral.
Yeah.
All right. We haven't seen a lot of difference, but a lot of it's due to the current uncertainty. There's not too much more to point out here. Fiscal policy's gone green.
Right.
And credit demand's gone green. Geopolitical, that's always going to be, it's been in the red
Still a lot
for a
going
long
on
time.
there, yes.
But other than that, we haven't seen too much. I mean, look at consumer spending, which is very important. Are we reaching into our wallets and spending? Seems to be. But is there anything specific you want to touch on here?
Well, I think, and again, this is our look out the windshield, forward looking, and I think now we're kind of bringing things up to date. We've had our look at the first half. Where we are right now as we're recording this, we're coming up to President Trump's initial deadline for imposing tariffs on countries that he hasn't worked out a trade deal with. And honestly, I know initially they started out, I think it was very optimistic, 90 deals in 90 days. Well, I think there's 3 or 4, and I don't even think they've been finalized yet.
Right.
There's frameworks. So I believe, at least if you can believe what's coming out of the White House, I think there's progress being made, and it seems to be having some favorable effects. But we don't have any deals actually inked at this point, is my understanding. So it's been pushed off now a little bit to August 1st. Yeah, and I think what we're still seeing here is the uncertainty is still out there. There's not a lot of concern from at least everybody I read and listen to and everything. Probably same with you too. I mean, almost nobody is predicting a recession at this point. Yeah.
I smile. We're not in recession territory.
Right.
Slowdown?
Slowdown, I think, is that it. And I think this is reflective of that. A lot of yellow there, a lot of caution. I think what that's indicating is we still don't have a resolution on the biggest issues out there,
right.
And that's the tariffs. So we're probably going to see that, for a little bit more moving forward until some of these deals start to get set out, or we realize there are no deals and we see what a final tariff rate is imposed by the White House on specific countries.
Right.
So.
I'm sorry. You wanted to?
No, this is it. Yeah.
I got click happy there. We got this new little box. It's easy to move forward now. So this is a great chart. Go on.
Yeah. Well, no, and again, we're taking advantage a little bit of the fact that we're at the end of the first half of this year. So a lot of the money managers that we work with put out kind of mid reports and stuff like that. So I jumped on this one. I reviewed a lot of them, but this one again was by American funds, and many of you have at least heard of American funds. You may be invested with them now. I believe they do a good job. I think of kind of spelling out some basic facts here. So really what they're showing is right now we are in a period, as reflected by that last slide, where there's policy uncertainty and it's starting to weigh on the market. So we're moving toward a point where the markets really want to see some resolution here. The big word they highlighted there is uncertainty. And I think that's it. And it's difficult if you're the CEO of a company to plan for the future when you're unsure what that future is going to be.
And back to those small caps, when you're CEO of a small company, it might not have a lot of cash on hand to be able to stockpile some of the raw material you need. This is why the small caps may be hurting a little bit. Large caps may be up. But I mean, this graph over here, you took a look at the growth and the growth projections. Everything's been downgraded, and over here, this is the uncertainty or the economic policy uncertainty.
Yeah.
I hate to even say the words, but we're pretty close to where we were at the pandemic.
I think,
but I don't have the same feeling of doom or angst that we had then. And
there's a lot of I've been hearing, again, people I read, people I listen to, there's a lot of reminders going around out there that our economy is about 70% services based. And there are no tariffs on just about there's ways where you could figure a tariff may have an impact, but for the most part, there's no tariff on services. So when you've got 70% of the economy that's not really affected by this uncertainty, there are people out there, many of them in academic circles, they're looking at this from the economics backgrounds and everything, but they're saying, these tariffs have to impact significantly that remaining 30%. And as of right now, nothing has really been imposed that's that significant of a change. Now, it could be coming. We don't know that. And again, so that's why it's not a lot of cold, hard numbers at this point. It's the uncertainty as to what those numbers may be at some point in the future. So that's it. But you're right. Yeah, growth projections have come down, although they're still positive. I mean, we're not to the point
We're
where
slowing.
they are talking. They're slowing,
It's slowing.
yes, and revised downward, but not coming to a screeching halt by any
Right.
means.
And I think a lot of this shows, you and I were talking earlier today about the bond auctions, and that's where the
Yeah.
United States takes their debt, be it a 3-year, 2-year, 10-year, 30-year bond, and they put it out to auction, and then other people, individuals, countries, and companies buy that bond to fund our debt. And what happens is those auctions have been going well. In other words, we've been able to fund our debt at a fairly low rate. That means that our growth should be just fine. What we did see, though, just recently in the 3-year bond auction, they had to raise the rate in order to sell all the debt. That means that in order for somebody to buy the U.S. debt, we had to give a higher rate in order for it to be fully subscribed. Good or bad? Sign of the times? Yes. Remember, bonds are the health of the market. Equities are the trend of the market. This could be, and I don't want to scare anybody, but could be. Let's keep an eye on that. Jeff and I look at the 10-year quite a bit, and anything with a 10-year over a 4% yield, that's where we show slowdown. But
Right.
Is it expected?
Yeah, I think
Are we prepared for it? Yeah. Look at the returns we've gotten.
right.
It's not a doom and gloom day, and let's not go, and I said it last time, let's not borrow trouble.
Right.
Let's let this unfold and see where it goes. And but look for the signs, move to the higher ground. This is a nice slide too, Jeff, again from American Funds, right?
Yeah, American Funds. And what they were attempting to do here, I know it's a little busy, but what they're attempting to do really is to kind of show, traditional alliances, expansionist policies, economic decoupling, trade deals, a lot of fancy words. But what they're saying is we really are at a point where the global economy could go in a couple different directions. And so what they're trying to say is like the trade battlefront, global tariff and trade measures spike in response to U.S. policy, but alliances remain intact. Right now, one of the bigger issues that I think that we really have that we're concerned with is we don't have a trade deal yet with the European Union, with Japan, with South Korea. These are some of our biggest allies in the world. So what American Funds is saying is, look, everybody could play nice in the sandbox. We could come up with something that everybody is happy with, that can prosper under. We get deals in place. And now we've got our traditional alliances are intact, and we've got trade deals. Unfortunately, it has the potential, we're not saying this is going to happen, but it has the potential to go a different direction where some of these traditional alliances start to fall apart a little bit, or maybe realign themselves. Maybe there are other countries that step forward that are willing to enter trade deals with us, and we develop a stronger relationship with them at the expense of maybe some other countries. So there's different things that could happen here. But again, so far, at least, like Dan pointed out earlier, I mean, we're not even 200 days into the Trump's term here. So where all this gets worked out and how it plays out, we definitely could end up a stronger country at the other side of this, or there could be shifts in this alliance.
You sound a little uncertain.
Oh, I guess a little uncertain. That's the word of the day.
But it's important for our investments and our money managers, nimble. Individual stocks, individual bonds, for the fact that we can pick and choose. We can play to the strengths, stuff like that. Right. As this unfolds, it allows us as investment advisors and the money managers we employ to just be able to be nimble.
And active management. I mean,
this is where it's going to come to play.
Having somebody, watching your portfolios every day, making moves based upon the news that comes out, making moves based upon the new alliances, the way things are shaping up, the economic numbers. These are all very important, and it's not a set and forget strategy.
And let's not be emotional.
Yeah, that's
right.
True
Let's pay attention to the true numbers and not act emotionally. This is Trump's first term, 2018 versus 2019. We kind of are living this 2018 right now, aren't we?
We are kind of, and that's why I threw this on, just as this is kind of our final slide, just to say, listen, there is a little bit of precedent for this. Things are definitely different this time, because I know you say don't always say that, but the trade war, so to speak, that Trump started in his first term played out a little bit differently. However, The point is, though, that there could potentially be some realignment here that could result in a very favorable economy for the United States. And obviously that would then bolster the U.S. financial markets, which is where we're all invested.
Right.
So.
And we didn't have a lot of time today in this episode of our webinar in July to really go over the big, beautiful bill. But that's going to be something else that will play into this. That could be, positive, negative. So that's another little bit of things out there.
Yeah, right. At some point,
we'll have to deal with.
Yeah, we'll probably highlight, some of the changes that are going to come along as a result of that. Some of them, could be favorable. Honestly, at this point, everybody I think is still sorting through the bill itself just to see what impact it might have on different areas and different classes and whatever. But it's we're gonna see where all this goes.
Right.
So.
Well, I want to thank you very much for joining us for our July webinar. I hope this is helpful. If you find it helpful, don't be afraid to forward it to a friend. All right, you have a great week. Take care.
Thank you very much. Thanks.
Bye-bye.
Bye.